Credit markets crumbling. Hi, everyone, and welcome to another episode of Insights brought to you by Ainslie Bullion and the Gold and Silver Standard. Today, we welcome back Sam, who's he's been looking at everything credit, really, personal credit, country credit, all sorts of things, and brought them together in the news article today. Also, I had a little look in there at silver, which I would like to just touch on at some point in this discussion as well, because that's had a little pop overnight, so that was interesting. But welcome back, Sam. How are you going?
Great, Chris. It's good to be back and can't wait to jump into this data.
Yeah, absolutely. So let's start off on that credit card stuff that you were talking and credit generally that you're talking about. According to those reports, there's been it's been interesting to me because you've had, and I think we've talked about in the past as well, this idea that it's been good, all this positive news with consumer spending on credit cards, and it was really seen as quite a positive. But you're really sort of painting that in a slightly different picture, in a different way today, to say, well, all that comes home to roost. So, or how could that possibly go wrong? Can you maybe start off by talking a little bit about that?
Yeah, well, before we were talking and looking in desperate situations, investors really look for positive news. Even if you remember at the beginning of the COVID outbreak, when a lot of currencies were having trouble, there was some positive retail spending that caused the British pound to skyrocket. Investors didn't even realize the data was from the month prior to the outbreak. So it's just really silly speculation sometimes, some very basic mistakes. And in this case, what we were talking about last time was this great spending data came out. And you and I sat here and talked about this fantastic credit card spending data. The only problem is, when do people spend on credit cards? Well, only part of the time, actually less than half the time statistically, it's just for getting those air miles and rewards and things like that. Usually people take out a credit card for emergencies. And that credit card spending, when did it happen? Did it happen when it's really easy to get credit, when
Mm.
interest rates are sinking? No, it happened when people are feeling pain and the cost of goods is going up. So this data is that 16% of credit card holders in Australia, either one, are over their credit card limits, or two, are unable to make repayments. Now, that's not just a temporary issue, because when people are over the limits, they're unable to make repayments. It only goes one way, really. The fees start adding up. It starts compounding with the interest, and it gets worse really, really quickly. And most people will have a few credit cards, not just one. So what used to be lily pads to jump from here to there and have a way out becomes a bit more like musical chairs, where they start disappearing.
And that's such a good point about this idea of having that sort of lily pad idea that you could jump from one to one, but then disappearing, and you just can't do that anymore. Because I think that's why people get into the trap, because first of all, the interest rates are extraordinary on some of these cards. Something I was reading recently was talking about how we were getting to new record highs in interest rates, and sometimes they're well into the 20% range. Like, that becomes an exponential problem if you're not on top of it, I can imagine.
Yeah, people think about interest rates like they're all watching what the federal interest rate is. They're all watching what the interest rate announcement is. People aren't looking at their own credit card and saying, "Hey, mine's at 20%, mine's at
Yeah.
almost 30%." It's kind of like someone saying, "Gee, it's getting quite dangerous in Beverly Hills. I wonder when it's going to reverse." And the person sitting there in Compton, it's people need to look at their own situation and see how's their credit doing. And then if you look at the last 2 years, credit card debt's aggressively increased in Australia. So
Yeah.
it's not just a recent phenomenon. It's not just like things are about to get better. Maybe we're about to pivot. Let's
Well,
just go
that's a
and
really
get
good
that credit
point.
card.
Like, do you think that maybe people are making those decisions on hopes that things are about to change? So do you think that maybe people are going, oh, well, if I can just get to the end of this cycle, or if I can just get past this next set of interest rate rises, is that what you're saying here, that you think that that is maybe driving people's decision making?
Look, that's what you'll read in articles from analysts. These are people with a lot of extra risk capital to allocate when they think the next bull market's going to happen, and that might not hurt them if they have, an extra 10,000 or an extra 100,000, they say, I think now's the time to throw money in and maybe start using some credit.
Mm.
It's probably not going to hurt them. What it's going to hurt is people who have to use credit cards, like we talked about. And you can see in the data the last 2 years, credit card debt has increased. Now, what's happened the last 2 years? The bear market. So it shows the bear market is correlated with this increase in credit card use. It's not just people suddenly saying there's a pivot, let's increase spending. It's been increasing this whole time. We're only just looking at it now because people are clawing for reasons why to start investing. They're looking for good news where there isn't good news. It
Yeah.
might just be more bad news.
So do you think that part of that is that people are really too focused on trying to predict, which is really what you've been saying? They're trying to predict what the banks will decide rather than looking at what's actually happening. Is that how you would see it?
I completely agree with that. One thing I would say just to compare is that a lot of people say, oh, how high will the interest rate go? Will we get to we've been at 18% before, we've been at this, and they're not really thinking about what's already happened, how much has happened, how quickly things have reversed. So just to give an example of a physical situation, we've all been in a car before where the car is going about 10 kilometers an hour, and then suddenly the car is going about 50 or 100 kilometers an hour. Getting onto a highway, pulling out onto a main road. How painful is that? Well, it's not painful at all. It's quite exciting. Going from going from something like a low, maybe a high interest rate environment to a lower interest rate environment. It can be fun. It can be like accelerating a car. But how about if you're going 10 kilometers per hour this way, and then suddenly you're going 10 kilometers per hour this way? Well,
Not
I've
quite as
never
fun.
done that. I've never done that because that would be me getting hit by a semi truck. That would mean I wouldn't be here right now, or I'd have whiplash. I'd potentially be permanently injured, dead from something like that. So it's the reversal that causes so much damage. It's things changing around and going the opposite way. And that we always talk about the timing. There's a point of maximum benefit. There's also a point of maximum pain. So that point of maximum pain comes from these lagging consumer prices. Just for example, you look at, let's focus in on something like a house or like the cost of groceries. So you're getting paid X amount. You want to buy a house. Now, how expensive are houses now? How expensive are mortgages now? How expensive are groceries now? So you start to do that. Has your income caught up yet? Well, for most people, not even close. If my income multiplied the same amount, my cost of groceries multiplied, I'd be a millionaire very soon. And then you have a look at what the interest rates are doing. They're already rising, so credit's already becoming harder to get. So cost of goods, still high. Income hasn't even caught up to that yet. And then you have on top of that, it's harder to get money. So all the worst things happening at the same time. And that just leads to people having to sell when they don't want to sell, and people having to take on credit when they don't want to take on credit.
Yep. Well, that's an interesting segue, actually, because I'm really curious to know, and I sort of mentioned this at the start about we've had that little bit of a pop in silver. What's your take on how the physical metals markets are interacting with this? Because it seems like they have a bit of a split personality. It's like they like the chaos and turmoil, but they also like bull runs in the stock market. But they also, you've got people who will be under pressure and not necessarily have money available because of what you've just described through credit cards, needing to being underpaying from the interest rates and being underpaying from the inflation. So how does all this fit together in the metals and the impact with the metals markets?
Yeah, and a lot of investments are leveraged too. So I mean, leverage we have to thank for these huge booms as well as these huge busts. But the painful thing is if someone's just speculating leveraged on gold or silver, for example, and there's a slight dip or a surprise, in some data releases like the CPI data that came out. If that were to go the wrong way, that knocks someone out of the trade completely. So again, the physical metals, actually having it in your safe, the market can go up, the market can go down. Your gold and silver is not going to evaporate or disappear from some trading account somewhere or some contract. So the chaos and it's a legitimate question, and this is something I saw someone from Kitco actually asking an economist at the beginning of the last bull run, what's happening isn't why is gold essentially following the stock market instead of doing the opposite, and why is it still responding to chaos positively? And one of the easiest ways to put that in perspective is we're looking at everything compared to a fiat currency that's constantly devaluing, and it just doesn't make any sense. We're even looking at, people say, how's the value of the US dollar? Well, let's compare it to the euro. The US dollar index, you're just comparing it to other currencies, which doesn't make any sense at all. So it's kind of like if I ran and jumped out of this window behind me and I said, wow, look at Chris, he's going up. I guess Chris learned to fly. And look at that beautiful plant behind me, that started to fly as well. And look at this computer screen, this camera, everything's flying. Well, I could say everything is flying, or I could say, I think I'm falling out of a skyscraper window. Now, when the currency is falling out of a skyscraper window, we look at everything compared to the currency. So people say, what? Just like they said the last bull market, they said gold's going up, silver's going up, the stock market's going up. A digital picture of a monkey that you only own maybe is going up. Everything's going up, instead of saying the currency's going down. And it's as simple as that. You look at periods when the currency wasn't being devalued as aggressively, because Australia is pretty new to this quantitative easing. We haven't really done that here before, but we've joined the club of easy money, and you can see what happened. It used to be just a vehicle between risk and safety. So, bombs are dropping. Okay. The fiat currency is a vehicle to get you out of the stock market and into precious metals. And then, bombs start dropping. Times are safe. Everyone's jumping on that latest tech stock. That vehicle, the currency, drives you back over to the risk market, where you can make that 10 or 20%, these big gains you would be missing out on precious metals. But now the car itself is on fire. It's been completely ignited and it's burning, and people are just fleeing the car in both directions because everything's going up in comparison. The only thing I'd like to compare to there is, me being a manager at leverage trading companies for years. It's like they say, when you're financially incentivized to keep believing something, it's very easy to believe. Well, I've been financially incentivized for years to think that the stock market's going to keep going up, and you know what? I don't. Which is why I've been moving away from that. Both things go up, but one is at risk. Companies can go out of business. Other technologies can come out and surprise and make other companies redundant. Social media companies can disappear. You look at Facebook. Is it that different from MySpace? We've seen tech companies come and go, but gold and silver can't go out of business. So that's why it still remains strong in times of chaos. And we've just had that article come out on the website. It looks like record views, but the BRICS countries are looking at a gold-backed currency. So even countries are making the leap now.
And we could talk a lot about that. We might hold off on that and talk about it next week for sure. But I really like that analogy. You always make great analogies, but specifically talking about this idea that it's the denominator effect, as like Raoul Paul, for example, talks about it. This idea that everything looks like it's going up and we're just looking at the wrong thing. And that's exactly what you've been highlighting here. It's really the debasement of the currency that's the issue, not necessarily that these other things are rising. They're really, particularly in the case of gold and silver, they can be staying absolutely dead still and they're still doing their job. And on the graph, it still looks like they're going up. It's a really important point to understand.
Yes, the easiest way to make everything in this room fly is for me to jump out the window. It's as simple as that.
Absolutely. It's a fascinating way to look at it. Well, thanks, Sam. We've run out of time, but thank you so much for making that really clear and really highlighting a few issues. We start off talking about credit, but end up seeing that it all is related. It's all really part of the same story, whether it's at your personal level with the credit card, right up to a country level with central bank balance sheets. We're really talking about the same thing, aren't we?
Yeah, absolutely. Well, thanks, Chris, and see you next time.
Yeah, thanks so much. Thanks everyone else for watching. Remember, reach out with any questions or comments on the social platforms. That's us for this week. We'll be back on Tuesday next week with Alex to discuss all things markets and metals. Until then, have a great weekend, everyone.